Buying your first stock feels scary, not because it's hard, but because you're afraid of making a mistake. What if I buy the wrong one? What if the market crashes right after? Or what if I mess something up? In this video, I'll show you exactly how to buy your first stock step by step, so you can place your first investment confidently. In the previous videos, we covered how investing actually works and how much money you really need to start. Now comes the moment everyone waits for, actually pressing the buy button. Before opening your brokerage account, you need to answer one simple question. Am I buying an ETF? Or a stock? ETFs or exchange-traded funds are best for first-time investors. They give broad exposure, low stress, and one-click diversification. If this is your first ever investment, an ETF is usually the smartest place to start. Now, if you have a little more experience, you could progress into individual stocks. If you're buying a single company, it should be profitable, well-known, and easy to understand. No hype, no next big thing stories. But how much should you buy? And this is where beginners panic, so slow down here. You do not need thousands of dollars. Fractional shares are fine. $100 to $300 is enough. You don't need to go all in. Your first investment is about learning, not maximizing returns. Now let's look at order types, and this is where mistakes happen. The market order is beginner-friendly. It executes directly, is simple, and good for liquid ETFs and large stocks. The limit order is an optional upgrade. It sets the maximum price and is useful in volatile markets. If this feels overwhelming, use a market order. Perfect execution is not the goal, starting is. Let's say you want to buy one share of Apple. You could search for the ticker, which is AAPL. So let's click on it. You get to this screen. Usually you see a chart which you see on the left, and currently the price is at $259.04. When you press buy, you suddenly see two prices. You see a bid and ask. Now, quick reminder before we go further, you can't break anything, and every long-term investor has done this exact step. Right now, Apple has two prices because there are two sides to the trade. The bid is what buyers are offering for Apple shares, and the ask is what sellers want in order to sell Apple shares. Think of it like a negotiation happening instantly. If you place a market order, you're basically saying, I want one share of Apple right now at the best available price. So the order fills using the ask price. For a buy and hold investment strategy, this is totally fine. A limit order just means you want a little more control. You're saying, I want one share of Apple, but only if I can get it for this price or better. Let's say you set a buy limit between the bid and ask spread. So let's say in this case we do 259.35. If Apple drops to this price, your order fills. If it doesn't, nothing happens, you don't lose money, you don't mess anything up, the order just waits. And when you're ready, you review everything and then you send the order and you're done. Now what happens after you bought your first stock? The price will move. That's normal, and you should ignore daily fluctuations. The biggest beginner mistake is watching prices right after buying. Once you buy, your job is mostly nothing. Your first stock is not about returns. It's about building the habit. Consistency beats intelligence in investing. Like we saw in our previous videos, invest monthly, use dollar cost averaging, and have a long-term ownership mindset. If this video helped you feel more confident, like it so more beginners can find it. Subscribe if you want investing explained clearly without noise or hype. And comment below, what's stopping you from buying your first stock?